The desert gleams under the summer sun, and beneath the neon of the Las Vegas Strip lies a commercial real estate market in transition. Welcome to RipplEffekt Market Intelligence. I'm your lead correspondent, and today we're drilling into the numbers that matter for institutional investors, brokers, and asset managers operating in Southern Nevada. Mortgage rates sit at 6.58%. The Fed funds rate holds at 5.33%. And the employment picture shows 3.7% unemployment across the metro. This is the data infrastructure of Las Vegas in late July 2026. Las Vegas continues to absorb capital and talent at a measured pace. The 30-year mortgage environment remains elevated, which directly constrains residential leverage and consequently shapes investor appetite for multifamily and single-family rental portfolios across the metro. Inflation, year-over-year, registers at 3.4%. That's a meaningful data point for cost of capital calculations and for anyone modeling rent growth assumptions. The unemployment rate at 3.7% reflects a reasonably tight labor market, which supports wage pressure and sustains household formation. Housing starts in the metro have reached 1,380 units. Let's crystallize the key performance indicators that should anchor your investment thesis. The 30-year mortgage rate of 6.58% remains the primary headwind for traditional residential buyers. That rate environment continues to suppress demand from first-time homebuyers and creates significant opportunity for investors willing to hold rental portfolios through a higher rate cycle. The federal funds rate of 5.33% sets the baseline for all capital costs in the market. We're estimating that figure based on forward guidance and current policy trajectory. At 3 dominant trends are shaping Las Vegas commercial real estate right now. First, rate sensitivity. We are in a higher-for-longer interest rate environment. That's not conjecture. The 30-year mortgage at 6.58% and the Fed funds rate at 5.33% define the terrain. Institutional investors are recalibrating expected returns upward to compensate for that elevated cost of capital. That's creating bifurcation in the market. Prime assets, well leased, with strong sponsorship, continue to attract capital. Secondary and tertiary assets are experiencing compression and extended marketing periods. Second, inflation persistence. At 3. Now let's turn to specific opportunities. RipplEffekt's research team has identified 3 single-family residential properties positioned at meaningful discounts to zip code medians. First, 8640 Vivid Violet Avenue. Asking price $425,000. 4 bedrooms, 2.5 baths, 2,631 square feet. That's $162 per square foot, and it's priced 25% below the zip median. This property is newly listed, just 11 days on market, and it represents strong value entry for buy-and-hold investors focused on rental yield. Second, 9065 Starling Wing Place. Asking $373,000. 3 bedrooms, 2.5 baths, 1,476 square feet at $253 per square foot. That's the Las Vegas market as we see it: disciplined growth, elevated capital costs, and selective opportunity. RipplEffekt provides institutional-grade intelligence to investors, brokers, and asset managers. Our research team monitors mortgage rates, Fed policy, employment data, housing starts, and asset-level opportunities across your target markets. Whether you're evaluating portfolio strategy or vetting a single transaction, we deliver the data and context you need to move with confidence. Visit us at RipplEffekt.com for the full intelligence brief.